오늘은 회계 수업에서 정말 흥미로운 주제를 다뤘는데요. 바로 이익 조정에 관한 이야기였습니다. EarningsManagement라고도 하죠. 이익 조정은 단순히 숫자를 예쁘게 꾸미는 걸 넘어서 회계의 본질과 신뢰성에 근본적인 질문을 던지는 주제예요. 이익 조정이란 경영자가 회계 기준의 유연한 부분들, 예를 들면 수익 인식 시점이나 감가상각 방법 또는 충당금 추정치 같은 것들을 활용해서 보고되는 이익을 일정하게 조정하거나 조금 더 괜찮게 만드는 행위를 말해요. 수업 시간에는 교수님이 CBA 은행의 대손충당금 사례를 보여주셨는데요. 같은 기준 하에서도 이 정도는 더 쌓았어야 한다라는 의견이 나오더라고요. 그러니까 10%만 더 잡았어도 6억 달러 이상의 이익 차이가 발생할 수 있었던 거죠. 이게 바로 회계는 판단이다라는 말이 나오는 이유예요. 문제는 이런 판단이 항상 중립적이지는 않다는 거예요. 때로는 경영자가 의도적으로 좋은 결과를 보여주기 위해서 형식보다는 실질이라는 원칙을 좀 왜곡하기도 하는 거죠. 그리고 이게 심해지면 와이어 카드 같은 회계 스캔들이 터지기도 합니다. 매출은 커 보이는데 실제로는 현금이 없었던 거죠. 완전한 착시. 오늘 수업에서 느낀 건 회계는 단순한 숫자 게임이 아니고 판단과 책임, 윤리의 영역이라는 점이에요. 우리 같은 미래의 비즈니스 리더는 재무제표의 숫자뿐 아니라 그 숫자가 어떤 기준, 어떤 판단, 어떤 의도로 만들어졌는가를 들여다보는 눈을 가져야 한다는 것이죠. 이게 오늘 제가 배운 그리고 공유하고 싶은 회계의 본질입니다.
I agree with the statement that earnings management, EM, affects most of the accounting topics we have studied and that it is critical to question and challenge the quality of accounting information. EM undermines the reliability and neutrality of financial reports and therefore threatens the fundamental objectives of accounting, to inform sound ethical and transparent decision-making. Earnings management refers to the use of accounting techniques within or beyond the boundaries of GAAP to manipulate reported earnings in order to meet benchmarks or portray a more favorable financial position. It is commonly associated with aggressive reporting, creative accounting, and, in extreme cases, audit failure. Managers may adjust revenue recognition, depreciation, or provisions to influence financial outcomes, often under the guise of professional judgment. This leads to ethical concerns and highlights the ambiguity within accounting standards. While standards follow the substance over form principle, requiring that transactions be recorded based on economic reality rather than legal structure, EM often exploits this ambiguity. For example, banks may understate loan impairment expense provisions, thereby inflating profits. In our class case, many concluded that CBA's 2021 impairment provision of $6,221,000,000 should have been increased by 5 to 10%. If increased by 10%, this would reduce profit by over $622 million, showing how judgment and estimation directly affects earnings. This connects to the classic trade-off between relevance and reliability. Managers may use fair value accounting to improve the relevance of financial reports, but at the cost of reliability, especially when estimates are biased. The Wirecard scandal further illustrates how inflated sales and revenue recognition without corresponding cash flows can mask financial reality. The company had 1.9 billion euros in missing assets and ultimately collapsed, demonstrating that EM not only affects accounting theory but also has real economic consequences. Moreover, companies with low operating or free cash flow are more likely to engage in EM to appear stable. This misalignment between accounting earnings and cash flows provides another red flag. As highlighted in class, free cash flow can create conflicting incentives between stakeholders and managers, with the latter tempted to manipulate earnings to retain control over reinvestment decisions. In conclusion, EM affects various aspects of accounting, measurement, disclosure, financial analysis, and even auditing. As future business professionals, we must remain skeptical, apply critical judgment, and ensure financial information reflects the underlying economic reality, not merely the image desired by management.
You know, in the world of big business, there's this, let's call it a magic trick, that companies can pull to make themselves look amazing, even when things aren't so great. It all happens in a tricky gray area of the rules, and today we're going to pull back the curtain and see exactly how they do it.
Okay, just look at this number, 1.9 billion euros. A huge German tech company called Wirecard claimed this was actual cash sitting in their accounts. Then one day, the auditors showed up to check, and it was just gone. Poof, it had vanished into thin air.
So, you gotta ask, right? How does that much money just disappear? Was it some kind of sophisticated Ocean's 11 style heist? A catastrophic mistake? Well, the real answer is actually a lot more subtle and, honestly, kind of more alarming. It involves a technique that doesn't always break the law, but it sure does bend reality.
And that brings us to the art of, let's call it creative accounting, or if you want the official name, earnings management. Think of it as the secret playbook companies use to make their financial reports look like a masterpiece, even when the real picture is, well, not so pretty.
So, what is earnings management really? It's all about managers using the wiggle room that's already built into the accounting rules. They use it to tweak the numbers, to smooth out a bad quarter, to make sure they hit their performance targets, or just to make the company look way healthier than it actually is. It's a deliberate game of perception. And that right there, that's the key, to portray a more favorable financial position. That is the entire goal. And why would they do it? It's simple. You want to impress investors, you want to keep the lenders happy, and you want to control the story that the market hears about your company. It's about managing appearances just as much as it is about managing the actual business. Here's a great way to think about it. It's basically an Instagram filter, but for a company's financial health, right? You take a photo, it looks okay, but then you slap on a filter, you crank up the brightness, maybe sharpen it a bit, and boom, it looks incredible. That's what earnings management does. It's not creating something out of thin air, but it's definitely altering the image to look its absolute best. All right, so how do they actually pull this off? How do you bend the rules without technically breaking them? Well, it all comes down to exploiting those gray areas, the spots in the rulebook that require something called professional judgment. And let's dive into a perfect example of this from the world of banking. So here's a basic concept you got to know. Every bank knows that some of its loans are going to go bad. People are going to default. It's just a fact of business. So accounting rules say they have to estimate how many bad loans they expect in the future and set aside money to cover those losses. That pot of money is called a provision. But here's the kicker. It's an estimate. And this is where that professional judgment becomes incredibly powerful, because that single estimate has a direct line to the company's profits. I mean, look at this. If managers decide to be, let's call it, optimistic, and they underestimate the amount of future bad loans, what happens? They set aside less money. That difference flows straight to the bottom line, and the reported profit goes up. It's just a simple judgment call with a massive, massive financial impact. And if you want to put a real number on this, check this out. One analysis of the Commonwealth Bank of Australia argued its provision for bad loans was, let's say, a bit too low. If that bank had increased its provision by just 10%, a totally reasonable adjustment, its profit for the year would have fallen by $622 million. That is the kind of power we are talking about here. So you can see the immense pressure managers are under to make these favorable judgment calls. Which brings us to the real question for you and me. How can we see through the hype? What are the warning signs we should be looking for? This all gets to the heart of a fundamental tension in accounting. It's this constant tug of war. On one hand, we want numbers to be relevant, to give us a forward-looking picture using today's values. But that means using subjective estimates. On the other hand, we want numbers to be reliable, based on hard, verifiable facts. But those facts are usually about the past. This tension, right here, is the gray area that managers get to play in, leaning into those subjective, relevant estimates to paint the exact picture they want you to see. So, let's get practical. Here's your red flag toolkit. First, and this is the big one, earnings are going up, but the company's actual cash from its operations is weak or even falling. Paper profits are one thing, cash is real. That was the whole issue with Wirecard. Huge profits, no cash. Next, watch for aggressive revenue recognition. That's when a company books sales before the money is really truly earned. Third, look for weird, unusual changes in their accounting methods, like how they calculate depreciation. A sudden switch can be a sign they're shopping for a better number. Fourth, be wary of big, one-time gains from selling stuff, like a building or a whole division. Sure, it can make a bad year look good, but it's not a sustainable profit. And finally, that last one, exploiting substance over form. That's when a company follows the letter of the law, but completely violates its spirit, using loopholes to create a misleading picture.
So the next time you look at a financial report and it just seems a little too good to be true, you need to ask yourself this question. Are you looking at the underlying reality of the business, or are you looking at a carefully curated performance? Because knowing the difference, well, that's everything.